Hello traders, and welcome to another edition of StratDog's weekly videos. In this video I will go through daily and weekly charts of S&P and DAX. I will compare these both indices and give you a story of how we got here with a Friday close and what could be next. So stay with me and let's start with the S&P on a daily chart. S&P had this structure after the news-driven gap up on Monday, May the 12th. This gap was on the US-China trade deal, while this week, Monday was a day on which S&P shrugged completely the US debt downgrade news, making a higher high. On Wednesday, we got the rising treasury yields news, which produced a sell-off on the US markets, and then on Friday, there was a news-driven move in the overnight session for the S&P on Trump threatening with 50% tariffs to the European Union, and markets went down but where S&P went down? It went down directly into large time frame support, and that large time frame support is this level 5,775, which I'm showing for weeks on this chart, and daily 200. This call out here was from before market opened. On the way down, there were some logical speculations that traders could make, and I will show you that now. For example, May 21st, Wednesday. This is before market opened. So we had only Monday and Tuesday candles closed. This is Monday, this is Tuesday. When you have this kind of structure, meaning outside, then inside day, that's a good chance for expansion. Expansion today, meaning on Wednesday, and this is what we got. At the end of the Wednesday, we got this. So really, after this structure, we did get expansion. Or this expansion was news-driven, with that treasury yields rising. Then, after expansion was given, we could say, okay, below that we have, because this is zoomed in of this, we have daily 200 as support and this gap if they continue down. And the same thing we could say on Friday before the open, that the rising daily 200 can come in line with the upper end of this gap. Now why is that important? Because S&P, like DAX, is the old school instrument. What that means is those instruments are likely going to react on daily 200, daily 50 and gaps. And obviously gap fills. Now the concept goes like this. If markets make a huge gap, that gap is first unlikely to be filled from the first attempt, and second, both upper and lower end of the gap can serve as support. And when you know that kind of concept, and when you have large time frame awareness, meaning you are aware what is happening on large time frames like daily chart, and if you are a short-term trader, you can then use that chart to plan well in advance your either hit and run day trade or maybe potentially a swing trade. In this case, we had days to prepare for the long if market goes down into daily 200 and to test this gap, because likely they're going to bounce from it. And then you compare and use this chart with smaller time frames like this, for example. This would be S&P index on hourly chart, this would be futures on hourly chart. And you see from that area where level 5,775, which is large time frame level, was, and daily 200, which is large time frame reference, we got the bounce, and then that bounce died at the previous session low, previous session regular trading hour low. This is futures. These shaded parts are overnight session. If you want to get the same look here on futures, you just go to regular trading hours like this, and then you're going to get the same. RTH references, meaning regular trading hour references, are always more important than overnight references, and this here could be used as a target for longs, but also for sellers who wanted to use downside news-driven momentum to catch a pullback and to sell a pullback. So this here, previous day low, serving as a entry point for sellers and exit point for buyers. Okay, now back to the chart, and let's go through the potential scenarios for the next week. First of all, what we are having next week. In the economic calendar, FOMC meeting minutes on Wednesday without press conference. That means likely it's not going to be really that much important. Then on Friday, we are having PCI index. We are also having Monday as a non-working day, which you can check on the New York Stock Exchange trading days calendar. You see here Memorial Day on Monday, which means that markets are going to be closed, meaning stock market in the US is going to be closed, but futures are going to work with shortened trading session. So basically Tuesday is going to be very important for positioning into the FOMC, and to also, which is much more important, to see is this support is going to hold or not. Because everything that we can see here, this down move, this up move, everything here was news driven with Trump and tariffs, everything of it. And markets are prone to shrug the news if that same news are continuing over and over again. So we already had a huge bounce from the level. This was given also, you can find on my YouTube channel that video from April. I have emphasized this level. This wasn't really hard to see. This is a level which is clearly visible on daily, weekly, even monthly charts, and I used monthly charts for that. What I'm trying to say here is that when market goes sharply lower into the known large time frame level, it usually do two things. First, it bounces in front of the level, and second, which is more usual and happens often, is that they pierce that level a bit. Low of a day on a Friday was 5,767, which means only 8 points below large time frame level of 5,775. Since daily ATR on S&P futures is around 90 points or so, you know, everything that is like 5 to 10 points should be considered as really a small move. This is something that is only for scalpers. So if market goes 5 to 10 points only below large time frame support, consider yourself as a lucky man and say thanks to the gods of trading, because they made just a small spring, meaning a very small false breakdown or look below and fail of large time frame level. And you can see how this market neatly bounced from daily 200. What can happen next here? Two scenarios. The bullish case would require for the market to either hold this area or just make another poke, which could go a bit more inside this unfilled gap, but then to push higher. For that kind of purposes, you can use other references for you to be like a gauge of false breakdown. I will show you now what I mean. This would be daily 20 or midpoint of the Bollinger Band, while this would be daily 50. So all of those are simple moving averages and industry standard when we are speaking about daily charts. So for example, imagine the market goes below daily 200, below this level, but just to test daily 20 to the point, and then they are going up through daily 200, through this level and back into this structure. That would be the bullish case, and in that case, you should aim toward the middle of this structure and toward the upper end, toward the Monday high. That would be bullish. What would be bearish? Bearish thing need to clear daily 200 big wave. When I say big wave, I think to make real breakdown, to close below daily 200, to fill this gap, which was made once again on May the 12th on US-China trade deal, and then to have downside follow-through, which means closing below next large time frame level, which is 5,700, and closing and getting downside follow-through. See how this level, which was November 2024 low, was very useful here and here as resistance, here as well, and market gapped above it. So on the way down, this level could also be very interesting for us. So downside continuation requires, once again, real breakdown below large time frame level, daily 200, then daily 20, filling the gap and then going down. When we observe DAX basically did very similar thing to the S&P. While S&P poked a bit under its own large time frame level, DAX did the same. Large time frame level in case of DAX is 23,350. When we go back to the S&P, which we can also conclude that these levels here should be considered as stronger ones than the one from DAX, because here we have also daily 200, and we can also conclude and should conclude that DAX is still a leading market and much stronger than the S&P. S&P is basically sitting at the daily 200, while that same daily 200 is all the way here on DAX, and on the way down we have daily 50, which is above daily 200 and not below like on the S&P. But in both cases, eyes should be on start of the next week right at large time frame level and at Friday low. Those are the first things that buy side needs to defend if they want to continue higher, and in that case they could just spend a week or two consolidating in this area before that up push. For downside continuation, like on S&P, DAX would need to see breakdown below this level, which means close below the level, and then going down, and on the way down we are likely going to get a rising daily 50 in line with this gap here, which was between, as you can see, between April and May. This is the May low. Upper end of a gap is also May low, which is important for us. And any kind of bigger downside obviously would need to go below this gap and below daily 50. So that would be about the bigger picture on DAX and on S&P on daily charts. And let's compare now these markets on weekly charts. Let's start with DAX. DAX had, as we can see, two dojis, and this second one is the outside candle, and they are still holding above the previous double top all-time high. Clearly stronger market than S&P. While S&P, as we can see here, had two weekly candles. This one is slightly outside candle of the previous one, and we can say basically that we are looking at a 2-week consolidation. Pretty much similar things is on Nasdaq, which is the stronger US market at the moment, you see. And also what we can see here is that the weekly high was just a poke above the previous week high. So always remember to have on your smaller time frame charts references like previous week high and low and previous session high and low. This is a Dow weekly, also outside red candle, a weaker market, and the weakest market there would be Russell, which filled that gap from May the 12th on Thursday. They didn't do that on Friday, they filled it on Thursday. Dow Jones filled it on Friday, while Nasdaq and S&P are still having this gap. This thing on US markets, that they are not in sync, that there are some weaker, some stronger markets, could actually help in a down move. So that's the thing to carefully observe from the start of this week. The question, fundamental one, could be, are markets are shrugging all of these negative news? Are they done with reacting on the tariff news and on threats? Are all of those news just dips to be bought, or they're actually going to go lower? And for that part of the question, we're going to use technical analysis, and we're going to use these large time frame support levels and references that are there on our charts for weeks and months. So that would be it in this edition of S&P and DAX bigger picture. You can follow me on Twitter, where I often comment about these markets and often showing small time frames and large time frame charts. I wish you a pleasant weekend and good trading.